Let's jump right into this explainer, because today we're dismantling a super common and honestly totally dangerous illusion in the startup world. We're talking about that jump from pre-seed to seed funding. So many founders just assume a seed round is basically a supersized pre-seed. More money, same kind of vibe, basically the exact same pitch but with extra zeros. But here's the reality check. That mindset, it's going to absolutely kill your fundraising before you even sit down in the room. The stakes literally couldn't be higher here. Get it wrong, and your company dies. That's why today we're focusing heavily on why seed rounds desperately need hard metrics.
Now, it's a completely natural assumption to make, right? I mean, think about your journey so far. You successfully raised pre-seed money, maybe 50 grand, maybe a couple 100,000 from angels or wealthy connections who just believed in you. They believed in your passion and that scrappy prototype. So you naturally assume seed investors are just going to write larger checks for more of that exact same thing. You've got some early traction, the enthusiasm is there, product looks great. It feels like a perfectly linear progression, but it's not. It is fundamentally wrong. What worked to get your friends and early angels on board is definitely not going to get a professional VC to write a multi-million-dollar check. I love this quote from our source material because it hits the nail on the head. The jump from pre-seed to seed isn't just bigger checks. It's a completely different game. That perfectly captures the massive psychological and operational pivot you have to make right now. It's a whole new game. Different investors, totally different expectations, and a completely different psychology. You're moving away from people betting on your sheer willpower as a founder to professional allocators making cold, calculated bets on your business. And they need hard data to back that up.
Which brings us to Section 1, the fundamental shift.
Let's look at how clearly the lines are drawn here. On one side, you have pre-seed money. This comes from forgiving angels betting on your potential. They aren't running crazy complex financial models or grilling your customer acquisition costs. They're investing in you. And because of that, they're super forgiving of mistakes. But seed money, that is professional capital. These folks run strict processes, comparing your deal to dozens of others every single day as part of their job. They have their own investors to answer to, so they absolutely cannot justify a check based on good vibes. They don't just want belief, they demand hard signals, momentum, and undeniable proof. Basically, pre-seed is all about potential. Seed, it's entirely about measurable momentum.
Let's move on to Section 2. Pre-seed mistakes that haunt you.
Take a look at this cap table scenario. We see this all the time. A founder goes out and raises a massive pre-seed round, say 300 to 500 grand, just because they could and they wanted a nice buffer. But doing that often means giving away 30 to 40% of your equity right out of the gate. You think you've got this cozy runway, so maybe you don't move as fast, you aren't as lean. But when professional seed investors see this, they see a slow-moving company and a heavily diluted founder. They know that if you only own 60% now, by the time you hit Series A or B, you simply won't have enough equity left to stay motivated. That makes them incredibly nervous. And honestly, it can kill a deal instantly.
And then there's the classic valuation trap. At pre-seed, raising at a $5 million valuation is totally reasonable for just an idea and a solid team. But say you spend the next 18 months building. You feel great, right? Money in the bank. But you aren't rigorously tracking your metrics. So when you finally go to raise that seed round and your valuation only bumps up from $5 million to $8 million, investors instantly see stalled momentum. Picture sitting in that pitch meeting. You had a year and a half, $500,000, and you barely nudged the needle on the company's value. Seed investors need to see undeniable progress between rounds. If your valuation barely moved, your data is screaming that your business barely moved.
And that leads to maybe the deadliest trap of all. You just can't spend a year and a half building the thing in a vacuum. A lot of founders do this, sometimes taking really bad advice from early investors that locks them into terrible decisions. But here's the reality of venture capital. VCs talk to each other. When you go out for your seed round, those professional investors are going to back-channel. They're going to call up your pre-seed angels and ask, hey, does this founder hit milestones? Do they listen to the market? If you spend 18 months ignoring customers and dodging hard metrics, those early investors aren't going to have anything good to say. The ghosts of those early mistakes will show up, and your seed round is going to be dead before you even finish the pitch.
So, how do we fix this? Let's get into Section 3, defining your success metric.
At pre-seed, it was totally fine to say, hey, we're exploring, or we're just going to build this and see what happens. That ambiguity was perfectly fine because you were searching for a problem to solve. But for a seed round, you absolutely must define a concrete seed metric. This is your undeniable proof that you've evolved from a dreamer into a data-driven operator. It proves you understand your unit economics, you get your customers, and product market fit isn't just some fantasy, it's actually happening. This right here is exactly why seed rounds desperately need metrics. Professional capital requires a measuring stick. You have to be able to look a VC in the eye and say, I'm not experimenting anymore. I found the lever, and if you give me the cash, I know exactly how hard to pull it.
So what does a concrete seed metric actually look like? Well, it obviously depends on your space, but it has to be hyper-specific. If you're B2C, that metric might be 50,000 active users, but you've got to pair that with high retention so they know it's not just a leaky bucket. If you're B2B, maybe it's 5 paying enterprise customers or really strong legally binding letters of intent. Or maybe it's just a hard revenue target, like crossing 50 grand in monthly recurring revenue. Whatever your metric is, you need to know that number inside and out before you ever start having conversations. Because again, seed investors are evaluating the hard business data, not just your charisma. They're literally buying the metric.
All right, section 4, the mechanics of timing.
A huge mistake founders make here is rushing. They raise pre-seed, spend maybe 4 to 6 months building, and then just immediately march down Sand Hill Road to pitch for seed. That is way, way too fast. As you can see on this timeline, if you do that, you simply haven't had the time to build real momentum yet. You actually need 6 to 12 solid months exclusively dedicated to finding, polishing, and growing that specific success metric we just talked about. Only then, once the data is totally undeniable, do you enter a 3 to 4 month pitching window to show it off. And you got to do this before your runway drives up, because if you're out of cash and getting desperate, seed investors will smell it from a mile away and they'll absolutely use it against you on the pricing and terms.
Following a disciplined timeline like this requires a huge evolution on your part as a founder. Just look at this progression. You have to transition from a scrappy visionary pivoting on gut feeling, moving fast and breaking things, into a highly focused operator, and finally into a cold, calculated, data-driven scaler. This evolution is so crucial because pitching for seed is tough. Pre-seed rejections from friends, they barely sting. But seed rejections, they are professional, they're data-driven, and they can be brutal. You might have to eat 20+ rejections from major firms before getting a single yes. Becoming a data-driven scaler gives you the armor for that. It helps you realize those rejections are usually just about your metrics not matching their specific fund math, rather than some personal failure on your part.
So, I want to leave you with this final thought to chew on. Take a hard look at your progress today. Audit your cap table, your early investors, and your daily operations. Are you intentionally building toward a specific, undeniable metric? Ask yourself right now, what exactly are you proving in the next 18 months? Because if you can clearly define that metric, measure it relentlessly, and walk into a room with the hard data to back it up, your seed funding won't be some desperate, frantic leap. It'll just be the natural, undeniable next step for your company.